S&P breaking out, small caps back above the 200-day moving average, NASDAQ with another new high on the year and 12-month high. All this is taking place when we're looking at the US having a downgrade of debt, non-farm payrolls, and massive bearish sentiment. Smart money, dumb money is giving us a glaring signal. Small speculators index position is flashing a warning sign for bears. Why? Broadcom's earnings report could be the most important of last week and what it means for AI stocks going forward. The collapse of certain retail names and how to profit from it. What Tesla is telling us about the market. We have a lot to go over. Let's get into it. Hey everybody, welcome back. We have a lot to go over. As always, subscribe to the channel, click all notifications. What we go over here is actionable and relative to the next trading week. So here we are with our level right here, and we can see that we've been saying 4,200 so much that we're kind of over it, and we don't seem like we're going to have to say it anymore except for support levels. This is a clear breakout. Your volume is kicking up. To make it even easier, look at this on the weekly. It doesn't get more obvious that you've had a base now going back to about, we could even say August. You could really make the case that if you look at this 4,200 level, that from back here and the crack and then the test and then the crack, right? You could actually make the case that your base is back here and that you actually have a year base. Now, we've been talking about this October low for some time, and I just think it points out the obvious. This was peak. In other words, this was peak inflation. This is when CPI was the highest, and since then it's been dropping. One thing that you should do when you have some free time is look at what happens when CPI was over double digits and then goes to 5%. And we were darn close to double digits here. So when it goes from double digits to 5%, I'll save you a lot of time. It was 1983 when that happened, and you can see what happened to the S&P from there. Am I saying that's what's going to happen again? I'm saying that I would try to understand what happens when you go from a massive inflationary environment to a possible deflationary environment and how the market responds to that. This would be a really good segue for me to explain something. So one of the big issues that I see that people are having a really tough time with is not understanding just what makes investing and trading actually work. View investing and trading as this is the top of a stool. It's going to keep investing and trading and tell me what's working. Well, the first thing is going to be macro analysis, right? So macro, meaning that econ data, okay? That's going to be important. And so we would look at that and go, okay, we're going to have to look at macro, econ, and go from there. And then if we look at that and go, okay, well, that's one leg. What would be another leg that we would probably think would benefit stocks, stock trading, things along those lines? And then we would say, okay, well, fundamentals, right? Fundamentals of a company are important. So that's probably something that we want to look at. And then say, yep, the fundamentals are going to be important to see if is a company earning more money or not. And then you would go and take a look at what. So the third one is technical analysis, right? So we're just going to call it technical. Okay, so now you have three legs of a stool. So if you think about investing from that standpoint, here's the important part that I want you to take from it. If you have a stool and you have three legs, if you took one of those legs away, the stool is not going to be as sturdy. If you focus on only one of those two legs, let's say we only focus on the technical, for example, okay, that stool is pretty wobbly, isn't it? So you can see why those three legs are important, right? So if you think about it from that perspective, that's when people are coming out and saying, well, non-farm payrolls was really bad. Well, non-farm payrolls has been bad for 13 or 14 months. So is that something that we really have to worry about? You know, fundamentals of companies, dependent upon the companies. Overall, the S&P is beating right now, right? It is exceeding the earnings estimates that are out there. And technically, we look great. There's very few people that are going to tell you that we don't look great. The other thing that you would take away from this, and I can spend more time on this, but I really want people to get this. What weighting you put on one of these is dependent upon how you're shifting, right? So if you're sitting and this is your stool and you're shifting towards the front, macro might be more important one time, fundamentals might be more important, or technicals might be more important. The weighting of these changes. Just because they're legs of the stool, in my rough analogy here, does not mean that they are all going to bear the same weight at the same time. And I think that that is where people are getting distracted. So I would remember that investing and trading is three legs. Sometimes econ matters, like PCE. Sometimes it doesn't. Sometimes fundamentals are going to be great and the stock's going to go down, which is going to be leaning on the technical side. Sometimes they're going to be awful and the stock's going to go up. If you think about it from a three-legged perspective, it'll make your life a lot easier. Let me know if you like that analogy, if it was helpful. I can do comments like that. If you comment below, let me know. I'm actually thinking of doing like a live monthly where I take questions, because I see a lot of confusion where people are looking at the index, they're looking at the markets, and they're just not getting what's going on. Now, this is what I mean. This is based upon a weekly, and I want to be clear about this. This is from Goldman, Global Banking and Markets, EM only, EA only, okay? But it gives us an understanding of what funds are looking for right now. Okay, do funds care about the yield? No, because the red line is your demarcation. So earnings yield, they don't care about it anymore. Exchange rate sensitivity, they don't care anymore. Okay, medium term momentum, they forget about it. Value names, no longer interested in. All right, so what are they interested in? They're interested in liquidity, right? That's important to know because that's going to explain why you're seeing the large caps move the way they are. And they want highly profitable companies. So if we understand where they're putting their money and where their focus is, if you go back to our three-legged stool and just think about it for a second, which leg should you be leaning on the most right now? Now, bear with me, and I know this one's a little cloudy. If someone has a way that I could make these a little clearer, let me know. What I want to point out here is this is global manufacturing PMI. I keep hearing how weak the economy is. The economy is so weak. Things are so bad out there. Non-farm payrolls is not saying that. What is happening is we are going from a society of manufacturing to society of services. If you think about what we do all day long now, we're not out there trying to buy the new shiny thing. We're trying to get a service that is going to make our lives easier. We're seeing a massive shift globally in how people are spending their money. And they're spending it on services versus spending it on things. So it's really important for you to understand this breakdown, and is why people look at manufacturing and manufacturing's coming down. It's more important to understand the dichotomy that's going on here and that the world is changing. Again, comment below. I think that that kind of information is extremely helpful because it explains what is happening. So in other words, this information is coming out, but at the same time this information is coming out, this is what the stock market's doing, right? You know, the one saying you'll hear me say ad nauseum, whether you're in the Alpha Chasers community or whether you do the pre-market live shows, you trade what's in front of you. You don't tell the market it's wrong. The market doesn't even know you exist. So if you take a look here, you're breaking out. Your next level is going to be this 43.20, right? You really don't need me for that. You should be able to see that pretty clearly on what's going on there. And what I think they're going to do is just continue to walk us up. What I find fascinating right now is the amount of bearishness that's out there. And it really just shows me just the complete lack of understanding on what's going on out there. So we're going to discuss this with AI, why it's going to be a huge driver, and we'll go from there. I might do a more specific video because there's a lot to cover here. But if we just take a look at what's going on out there, there's so many different things that I can point to, but let's start here. So this is QQEW, and this is equal weighting, meaning if all things were equal in the world, which they are not, but if all things were fair and equal in the world, this is what the NASDAQ would look like with an equal weighting. Well, what's happening there is that you just broke out. This is a really interesting distinction. I was watching someone on social media, and for anonymity's sake, I won't say who, but I was watching them post this and saying, oh, well, that's a hanging man. This pattern right here. And I just want to say something. When you come out and you start talking pattern recognition, it is really important that you understand the probability and back testing of what you're stating. If you look at hanging man positions, on average, they do not work. Okay, so if I have a pattern and it's less than 50%, do I really even have a pattern? It's just something to think about, right? You always want to understand the stuff that you're looking at. The more you understand it, the more use it has. So you're coming across and you're breaking out of equal weight for the first time in 12 months. You are breaking out of equal weight on the NASDAQ for the first time in 12 months. Now, we heard a lot about rotation. Oh, we're rotating, we're coming out. This is the NASDAQ versus the S&P. Okay? QQQ divided by SPY. You can do this yourself. You can do it on TradingView for free. I'm sure other platforms have it as well. I always try to give you free sites where you can do information, because especially with the newer people that get involved in trading, it gets expensive. 200 for this, 100 for this. So I try to find free sites. Now, if you look at what's going on here, what is this telling you? What's going on here right now? Okay, you're coming across, test, test, boom. This doesn't get any clearer. This could be in a textbook. So half the times I think I should write a darn textbook. But see your neckline right here? Comes back, test, boom, goes. This is undeniable. Am I going to care that 1 week we're over? No, I want this to come back in. Why? Rotation, rotation, rotation. Keep rotating, right? We love rotation. Rotation is what makes the world go around. Rotation is what keeps us in business, right? We want to keep cycling through. We don't want the money out. We want the money in. Now, the interesting thing that's what's happening with the bond market, before we do that, let's just talk about this with IWM. And I want to drill into this on a daily so that you kind of get this, okay? You're over the 200. You're over 180. This is what you need. Now, am I going to get all warm and fuzzy about one day? No, because this is usually, and I'm just like everybody else, like they've been playing whack-a-mole with our emotions, right? So in other words, every time we've been poking our head out, they've just been whacking us. So you start getting gun shy. Everybody does. It's just human nature. The important thing is to realize and understand what that feeling is, and then try to not let it interfere with your actual trading. The keyword is try. So what we're seeing here is we're seeing this breakout on huge volume. What's doing that? Well, we're starting to understand that going straight across here, we're starting to understand what? That maybe not every bank is going to go to zero. Let's look at the regional banks. Just FYI, regional banks, clean this off. Regional banks are 15% of IWM roughly. Okay, it's regional banks and services, but just think about it that way. So if regionals don't rally, IWM's not going to rally. Now, IWO could rally, which is the what? The growth sector, right? That is the growth sector of what? Of the IWM. So growth could rally, but your IWN is probably going to have a much harder time. Banks are not usually construed as what? They are not construed as growth. IWN is below the 200. IWO is what? Above the 200. Which way should you be looking? Go back to that graph I just showed where we said that they are no longer looking at value, they are looking at growth, right? Remember that chart? So if you think about that chart we just went over about 5 minutes ago, you can go back and take a look at it. Too much to go over today to go back. But if you take a look at this, it's pretty clear. Start running through the holdings of IWO on this breakout. I mean, I guarantee you when I run my scans this week, I'm going to find all kinds of names right across here that are just setting up, and you can just see the neckline, right? I don't even probably have to draw it for you guys, but I'm sure you all see that. You can see your breakdown right here. You can see your test here, your test here, your test here, bonk, 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 right? I mean, it's all through here. Okay, are you flipping? Maybe, maybe not. RSI says yes, but we're going to give it a little bit of time. Like everybody else, you're gun shy. Before we get into the bond market again, so you start saying rotation, okay, IWM's breaking out. This is big. KRE, look at this on the weekly before we get to the bond market. So you start looking at KRE and you start saying, well, wait a minute here. Higher high on the RSI. I didn't mean to make that rhyme, but it did. And you start seeing here and you look like you're going to push through, right? All right, so then you come here and you're just looking at it going, well, I mean, we've kind of been riding this line down, haven't we? Yeah, we kind of have. Okay, so we're trying to flip. Well, the first flip on regionals that you should be looking at is this gravestone, right? I know it's not a perfect gravestone, but it's there. So we're going to have to take what we have, not what we want. So you see that level right there, right? Get a close above that. Now look at this on the weekly. And I think that this is really critical. So here you are with the RSI. If my RSI looks different than yours, that's because I have proprietary settings on it. So if you look right here at how you tried to break out, now you're flipping. All I need to do to get my signal on the weekly is cross that 30 line. And getting above this little wonky doji right here does that. Now, does that mean that all the regional banks are buys and that we're not going to lose another one? No. Now, this is the bond market. This is what I'm going to talk about. You're going to start seeing articles out there, and I think we've started to see them. This is a once-in-a-generational opportunity to start buying the bond market. I don't know anything about that. All I can tell you is that you're starting to see people buy more bonds, right? We are seeing them buy more bonds. And as that continues, meaning the yield's dropping, and that's been happening since October, right? What else happened in October? Okay, CPI, right? That was the peak of CPI. Okay, remember that? And that was also when the S&P put in its bottom, which is now irrefutable. It's no longer up for debate. Even if you took out a low by some cataclysmic event that happens 6 months from now, staying out of the market because someday something might happen just kind of seems ludicrous to me. So you see how you're bouncing around in here, right? And you're trying to get through, but you're just not able to. So I would watch this 3 1/4 level, but this is telling you everything that you need to know. This is telling you that they are buying bonds, that the bond market is towards the tail end of the hike. Now, here we are on the weekly, and we're looking at the 1 month, and we can see the disparity between the 1 month and the 10-year. This will revert itself. As the spread, right, starts to revert itself, equities tend to go up. As this spread, meaning as these drop back down to reality, because the US is not going to default, once that happens, right, you're going to start seeing this happen. Equities will bounce off of that. Now, why am I showing the 1 month? Well, here you are in the 1 month and you're getting 522 on the 1 month. Now, you'll remember this graph from before. This is Fed funds on the weekly, right? So the important thing about Fed funds on the weekly is now they're able to borrow at 5.06% and go out there and buy the 1 month, the banks are, and make money. This stabilizes the banks. You will remember there was a period of time where you couldn't do that, where Fed funds was actually above. And when Fed funds was actually above what you were getting on the 1 month, people had to go out longer and then lever those bonds, and that was creating the problem. So this stabilization of Fed funds being under the 1 month, so now banks can go out and buy the 1 month and just know what they're going to do with their 30-day cash, makes their lives incredibly easier. I have a bunch of more macro stuff and just positioning of hedge funds I really want to go over, but I want to get into some of these names because there's some real glaring things here. Now, you would think last week my best trade would have been one of these net long semis, and I did well with some of those, but overall, my best trade, my easiest trade was just this AAP, and I'm just going to walk through it and explain this. So when you have a company that has a huge dividend, right, on a percentage basis, people own the dip because of the dividend, and you get rid of the dividend, those funds have to sell. They have to get out of the way. They don't have a choice. It's part of their charter. The moment that they cut their dividend and started talking, you knew that dumping was going to come in. What I would suggest about names like this is when you see that happen again, understand that funds are going to have to sell. Now, this is telling you a lot about what's going on in retail, and I find this fascinating, and I don't know if it's company specific or it's spread, and I'll show you what I mean by this. So if cars are going up in value and car dealers are selling more cars, which they are, why is the auto parts area just completely imploding? And so you start going through some of these, like let's use CarMax, right? And you start looking at CarMax. Okay, well, that's setting up. Okay, that's setting up and that's putting in a bottom, and it hardly moved when AAP came out. So then you have to start going through it and going, all right, well, what did O'Reilly do? Okay, well, O'Reilly popped on that news after AAP collapsed. Now, there's two schools of thought on this, and I'm going through this for a reason, and we're going to get to it. But if you start looking at this and go, get in the zone, auto zone, right? So you start looking at these names and going, well, we're cracked, we're below the 200. Okay, well, you always want to look at these names and go, okay, well, how do we act when we get to that 200? What usually happens there, right? Do we usually crack that, or do we usually bounce over it? And I think there's an important distinction I'm getting at here. You have this pandemic, obviously, but every time that you've closed below the 200-day, it's been a buying opportunity. Now, that flies in the face of conventional wisdom that you sell when you get to the 200, but I think there's something to this, right? So I always look at past performance and then want to see how we act. So I would watch this one out of all of them. To me, this is actually exhaustion. You can see right here that you had earnings. And it looks to me like, I thought they came out. It looks like they're coming out Tuesday, May 23rd. Maybe they just didn't put them in here yet. That's kind of odd. But you see this gap right in here, and then you have a gap here. Usually your second gap is your exhaustion gap. And you can just see you had net buying in this one straight across. So the question we have to ask ourselves is, do we have a problem there, or do we have a problem with AAP? I would argue that the problem would be with AAP and their management, and they're throwing it on the economy. Okay, that's what it sounds like to me. You should not be paying a dividend and then cut 83% of it. If you don't see that coming, that sounds like a management problem. And that's the important part of this. I don't think it's going to be all those auto part companies, and that might give us an opportunity later with AutoZone. Everybody's aware of Apple. Okay? And I just want to point this out. When Apple starts getting over the 70 is when it has the greatest move. Okay? When you start getting over 70 on the weekly, it's when it has its greatest move. It does not mean that it's always going to be that way. It just means that right now, when this gets over 70, it has its greatest move. So maybe we shouldn't just assume that it's just going to roll over again, right? So then we start drilling into this and just going, okay, well, here's that trend, and we can see the trend line's broken. And this is why I find it so humorous that people are just saying, oh, well, we're obviously going to collapse. I don't feel that way, right? And if you've been watching this for a period of time and watching along, you'll note that I will change my opinion like I change the wind. And you need to do that. You need to adapt. You're not even over the high yet, right? So for this to be this blow off and these levels are so extreme in these conversations, you're not even there, right? You're literally not even there. So in order for this to be at a position where we should be talking about, is this a blow off? Is this something? You're about 6 months to a year away from saying 240, right? When you start bumping your head against the weekly upper channel and you're over 70, then come and talk to me. When you're here and you're just starting and you're just flipping and you're closing at all-time highs on the weekly, see that close? Okay, that is an all-time high close on the weekly. And you want to go out there and tell me that the sky's falling? I'm going to have a hard time believing it, because this is a $3 trillion company. Now, why is that important? Because that's not you or I moving the stock. Okay, that is institutional demand, whether or not that's coming from, commercial hedgers, large speculators, small speculators, it doesn't matter. It's very clear that this is heading higher. Now, whether it heads higher Tuesday or 2 months from now, that remains to be seen. But when you start understanding that all we've done since March is have a higher high every single week except one, but people out there are going to try to call the top, it's an absolute waste of your time. Now, to be clear, I'm not saying that the XLK, which has 20-something% of Apple, I'm not saying that we're not overextended. I'm not saying that, but let me be really clear about how RSI works. Okay, it determines the magnitude of the move, right? So when you're over 70, it's telling you that the magnitude's about to get greater or continuing to get greater. You can go over 70, come back down, never break 50, and then go from there, right? And then you're sitting in here, then you broke 70 again. Negative divergence, this tells you everything you want to know, right? This is so glaring on a weekly when you have a negative divergence like this. But the important thing about this negative divergence, I just want to walk everybody through, and again, it depends on your time frame. But if you go here, that happened in August. Okay, well, when did we peak? Okay, well, we peaked in January of 22. Okay, so August, September, October, November, December. You're going to sit out of the market for 5 months because of that, right? Because you're over. You would have missed 5 months if you just used this incorrectly. And I think that's a very important distinction. You have to take a look at what's really going on and then understand what these valuations and how to calculate this stuff and what it really is. Now, the majority of people will look at AVGO and go, my gosh, it's so overvalued. I can't believe that this is what's happening. There's clearly a frothy market out there, right? You kind of look here and you go, okay, well, maybe it is. But, you start looking at this line, you closed right on the upper end of the channel. I don't know that I'd want to play with that, guys. I don't know that I'd want to be on the wrong side of that. Let's go here and take a look at this one and go, okay, well, you weren't able to get above that. So on the weekly, this is what you're dealing with. Now, just disclosure, I just want to show where the RSI is. I use RSI a lot. The reason that I use RSI a lot is because it's a leading indicator. It's one of the only leading indicators out there, not in determining price, but in determining the magnitude of the move. And I would suggest that if you're using indicators, you understand what they are. Start understanding how they're actually calculated. It's worth the 5 minutes or 10 minutes per indicator to truly understand how they're calculated and what they are. It tells you a lot. If you take a look down here at the volume, this volume is just insane. You have not had anything like this And so you'd have to go back to the pandemic. And candidly, the pandemic wasn't even this great on what you're seeing with AVGO. So why is AVGO acting the way it is? Disclaimer, I have a stock position and an option position in this. So we had the pullback, right? You have this wonky, clear blow off. I mean, could be in a textbook blow off, right? But what happened? No follow through reversal, undercut here to shake you out, right? Because you have earnings and then people are like, just get me out of the way until the earnings. And then what do? You close here. Okay, so you look at that close and go 812. All right, then you come to this bar and go, what was the close? 812.73. Okay, they just all happen to close right on my trend line. If I get a close over that trend line, right? You get a close over that trend line. This is going to be like a magnet, and that's 854. There will be nothing in here. Now, how do I know there'll be nothing in there? Because I can use volume by price, and I understand what volume by price is. I can go look at my point of control here that's in red, and then I can watch my level here, and I can see the vacuum of supply over here. So if I get in here, 854 is where I think you're going to push to. I would be really clear about AVGO. The report was, in my opinion, good. Wasn't great. Their core business, one of the core businesses they're having issues with, AVGO came out and said their AI business is planning on going up 100% this year. That's all you need to know. Okay, the future. Where are they going? They're going to go up 100%. We can sit here and argue about PEs and price earnings multiples and PEG and all that. It's pointless. Okay, are earnings going to increase? Okay, at what possible rate will they increase? Well, they're looking at 100%. You want to bet against something like that, go for it, but you're standing in front of a train long term. Now, LULU had good earnings and then collapsed, and this was really somewhat disappointing. And the reason it was disappointing was it was a good quarter and everybody's thinking it's finally going to get us out of this range. But there's something going on here, and I think we have some kind of seller. Well, obviously we have a seller, but you start trying to figure out, this was last earnings and we gapped down. Guess what we had here? Look what happened here, right? So you can see news event, but this was earnings, okay? Up 50, down 50. But there's something really interesting that keeps happening. We kind of fill these gaps, but in a really weird way, right? So in other words, empty gap, but you fill it to that extent on the gap on earnings, then you come across and then you backfill ahead of it, and then all we do is drop. So I want to caveat here, I have a short position in this. And the point that where I'm showing you this is, do I really want to be playing around with retail in here? Do I really want to be trying to catch that quote retail bottom? And if you take a look at this, I have nothing but air below me. Nothing, right? We all know that gap. This is a 15-minute chart. Here's volume by price. This is a 9 EMA just to get a guide. So I broke point of control and I'm rolling and I closed at the low of the day on solid earnings. And I've got no supply to hold me in here. Okay, so to me, this thing could gap fill again. And I think the point I'm getting at is, why are we looking at retail names on the long side? We probably shouldn't be doing that for more than a trade. Now, they're probably washed out, but why even bother considering what's going on in the NASDAQ? Now, for breadth of the NASDAQ, I like to show NDTH. And the reason I like to show this as breadth is because you start seeing the 200-day moving average and what stocks are above it. Most people won't look at this. They're going to look at new highs, new lows, which we're going to in a moment. But if you take a look at what's happening here, boom, 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 right? I'm at 73% of all stocks in the NASDAQ 100 are over their 200-day moving average. Well, why am I playing around with retail names? And I'm nowhere near the peak, right? Because the peak is going to be up here. Okay, that's where your peak is. 88, 90. Okay, and you know when the market peaked. You don't need me to tell you that. We all know that the market peaked right in here, right? Oh, let me show you where that is. Right there, okay. So you start seeing the peak levels, right? 90, 90, 90, and then you start having lower, lower numbers. So here, what's happening? The breadth of the NASDAQ is going down. At the same time, when that happens, what is happening to the NASDAQ? It's going higher. What does that give you? You should know that the NASDAQ peaked in November 2021. I'm pretty sure I don't have to put that up there, but I can, just so people get that. But if you take a look at that period of time, right, you're right here. Okay, so that right. So as this is going up, what's happening? Okay, the breadth is dropping, right? Real companies are dropping. Forget the SPACs and all the nonsense, but the real companies are dropping. Okay, what's happening now? We're going higher and higher. Okay, so to equate this to August is just frolics. in regards to the breadth. It makes zero sense whatsoever. But the reason I look at this is because these are real companies, NASDAQ 100. These are not your SPACs. These are not the EV companies that were going to change the world that now make 4 cars. These are real companies. Okay. This is NAHL, and I got it from stockcharts.com. So I just want to go through what this is. This is your new highs, new lows. And there's a couple things that are going on here, right? You can see December 2023, and you're making lower highs, right? So in other words, I'm sorry, you're making higher lows. And now you're breaking out, and now you're above that new high level. Now I'm showing you this zoomed in for a moment, and then we're going to zoom out on it. And now when you see this level right here, there's 75, what's that telling you? Okay, well, you now have more new highs than new lows than any time that you've had since February. Okay, so that's an interesting statistic. Maybe there's more that we can get from this. So now what we're going to do is we're going to zoom out on this chart and look at it for 2 years. Now, you're going to notice a couple things that I think are really glaring. In 2021, all the time you were hitting new highs. Look at all these new lows that are all in here, and you should be able to see what I'm getting at here. But you see all these lows and how they're just rising and rising and rising, right? Maybe they're not all perfect, and life never really is, right? But you get it. So now you're back over that level, but what do you have here more than anything else? Right? If you had one thing here, what do you have? Well, you have this. Whether or not you want it or not, it's there. So what is that telling you? Well, that's telling you that the new highs are about to go higher. You kind of look at the MACD right here, and you can see how that just happens to be having a little cross right there at the same exact time, which probably means that you're going to have new highs. This takes a while to develop. When every week we had 30 or 40 SPACs going public, right? You have to let those go to zero. You have all these zombie companies out there. So that's why I use NDTH versus using new highs, new lows. By the time this caught up, we were already aware of it in the community. We were fully aware of it, and we were buying the NASDAQ. So when you see like the NASDAQ 100 names and they start going higher and higher, right? At the same time, what we were doing was just watching this little level. And we're watching the amount of stocks go over the 200-day. Well, all it had to do is just give me a little nudge. And that's all it did. We bought this, I think, at 27 or 28. I have to go look at my spreadsheet of positions. But if you take a look at that, that's where we're in. This is where you're at. Now, if you take a look from that perspective, that's not a bad return. Why everyone's talking about the sky's falling, the market's going to correct, you know, all that nonsense. Yeah, you're about 28% there, okay? So I think it's really important to understand that. And then you start looking at what the drivers are. And this was something we bought, I think, at 14, and we still have a position in. We did sell last week into this because we hit a third standard deviation on the Bollinger Band. I'm not going to walk through that right now. But this was all I needed. Comes across, and then I got my little nudge over. And I'm like, you know what? We're not going to break the 200 again. We knew that the NDTH was picking up. See, when you understand what you're looking at, you can make better decisions. If you take one thing away from this video, take that. When you understand truly what you're looking at new highs, new lows, you have to understand that that new highs, new lows list looked like that in 2000, 2001, 2002, because you had all these companies that were just going to go to zero. I mean, you had like 30 different pets.com back then, right? Same thing with all this nonsense we had that just happened with these SPACs. So keep that in mind. I want to go through a couple other names here, and there's some real important data we have to go through. So let's get to it. So if you look at NVIDIA, I want to just go through something here, okay? You have retail saying it's going to pull back, it's going to do this, it's going to do that. You remember our stool, investing, trading, macro, econ, fundamentals, technicals, okay? Remember the stool? All right. And you're going to want to watch this video a couple times. So there's a lot in here, guys. So here we are technically, and oh, it's this, it's that. Okay, couple things. Non-farm payrolls comes out, no one cares. PCE comes out, nobody cares. This came out with earnings, and we have yet to break that level. We have yet to even test 367, okay? Really important distinction that's going on here. You have a technical pattern which clearly is overbought by any metric that we're going to use. I could put up 10 different metrics and we're overbought. Why are we staying up here? Okay, we're staying up here because when you came out with earnings that day, all right, your earnings are up 100%. In 2025, they were supposed to earn $11. Now it's going to be $18. They're supposed to earn The run rate is supposed to start June and July to earn $11 in the next rolling. Okay, so they're about 18 months ahead of schedule for their earnings. I don't think people truly get this. So one of the important things to understand is, yep, technically you can see that, and I would watch that level, because if you break 367.49, we might get lucky. We might be able to buy some of this sub 300. I would love that. I don't know that it's going to happen, but I would love that. So what's happening here? Higher high, we close above, and then we're in this little area. It's trying to break 400, having some issues with it, and we're going to have to see how that plays out. I do have a position in this. I will be maintaining a position in NVIDIA, and I'll trade around it for probably a fairly decent time now, because my position sizes are going out longer time frame based upon what I see going on in the market. I like this kind of market. You can swing it and also position trade. So if you look at how you're going here and you understand where you are, the technicals are overbought. Macro, nobody cares. Okay, we're no longer leaning on that leg of the stool. Fundamentals, my earnings have doubled. I want to be really clear about this, okay? It's not retail that's going to move a $1 trillion company. It's institutions. So retail is not buying this and holding it here on a $1 trillion company, okay? It's investment banks telling their clientele that they should be buying this, right? So what you're seeing, what people aren't getting is, even though the stock's up dramatically from this earnings, with the PE, the new PE, the PE of the company is actually down by about 20%. So you have companies out there that are explaining, like Goldman, to their institutional clients, that this is actually trading at a discount to this day. Okay. Now, whether or not you believe that or not, I don't really care. But that's what's happening. You could disagree with them, and you're welcome to do that, but understand how they're viewing this right now, and that's why it's acting the way that it is. One more thing on AI, okay? It is predicted in 5 years, it is going to increase gross margins in all S&P 500 companies on average 33%, meaning they will be able to hold 33% more of what they make. The number right now predicted for GDP, and usually these numbers are low, is around $7 trillion in 10 years. And if you think that's a fad, I can't stress enough how you're facing probably a once in a decade or once in 20-year opportunity. And do what you want with that, but you can timestamp it and cut it. So here you are, and you're equal weighting, and you're flipping over. Does this look like a NASDAQ that is just starting or just beginning? Forget your bias. How could you look at that and say, oh, this is going to break down? Clearly, this is going to break down. Or could you look at this and say this is an inverse head and shoulders, left shoulder, head, right shoulder, and we're about to break the neckline? Do with that what you will. RSP, which is the S&P weighted, you're kind of wonky here, aren't you? You're kind of rolling down a little bit here. So you're going to want to watch this. I mean, energy's bad. Financials are trying to hang in there, but at least we're back above the 200. This is very interesting. I have a position in Schwab, just disclosure. So if you take a look right here, here's your neckline. Neckline's at 60, right? So you start seeing this, and this is just about as ugly as you can get. I mean, that's like Bear Flag City, could be in a book. You start looking down here and going, anything under 49 on the weekly, we can't close below. If we close below 49 on the weekly, you know you should be getting out. But you are starting to see some signs here, finally, of life. You come down here, look at the RSI, we flipped 30 for the first time. I have a higher high on the RSI. I don't have a higher high on the stock. I don't see how you're not at least testing 60. So I do think there's some financial stocks out there that are worth paying attention to. I do think it makes sense to just point out a couple things that are absolutely glaring. The NASDAQ hit new highs without the S&P. Or I'm sorry, the NASDAQ hit new highs without the SOX. The NASDAQ hit new highs without the SOX. So that is pretty significant, and it's definitely something that I would be paying attention to, because that means what? The breadth is increasing. So we've given you 3 signs that the breadth is increasing in the NASDAQ in the past 40 minutes. As I said, there'll be a lot of information in here to pay attention to. Now, what is Tesla telling us about what's going on? Very simply, you're starting to see Tesla break out here. You're backfilling, you're testing, you're backfilling, you're testing, and now you have this wonky little pendant, And I got a comment the other day on YouTube, and please comment on these videos and what you like and what you don't like, because it does help me create content. And I know this video, I'm throwing a lot at you. That's why I always tell people to save these and go back and rewatch them. But if you take a look at what's going on here as you're coming across, starts flipping, boom, breaks out. Okay, we haven't had this. You have not had this in years. So if you start looking at, okay, well, there's a flag. Well, that one didn't work, right? So, and one of the comments was, oh, well, the flagpole is not longer than the flag, therefore it's not a true flag. I don't care if you call it a blueberry, but you have to understand these positions and what they are and what's going on. Now, I'm not saying everything's rosy here and you don't have any issues. I mean, we all see this. I'm sure we all see it. I'm just going to put it right in there so that we can see it. Let me click on that. There you go. And we'll go from there. Boop. So I'm sure we all see that, right? So, of course, there's a line there that we have to pay attention to, that 217. But if you flip that, you start getting into this. 275 is fairly quick there. So I would not rule this out. I would also be looking very candidly at what's going on with the volume and how it's spiking. And these are pretty much my favorite kind of divergences, because here is a higher high, then you're right here, and then what is the RSI doing? It's telling you that you're going higher. But there's even more to this, which makes it really attractive to me. So if I come to this peak, come straight across, and you look here, you're already breaking. You're already breaking that level. So I do look at this kind of detail. What I'm going to do is I'm going to clean all these off. You saw that break right there. But we're just going to put this right here so that you can see that level. So what is this forecasting, right? Now, I don't care if you agree with this or not, but I use it as a guide. And no, it does not mean you're going straight up. But to me, when this starts breaking, that means breaking this is a possibility. Now, let's just say it's not going to break that. That still gives me a target after 275 of roughly 300. Now, it depends, right? It could be at the same time that 275 that you're trying to get to and work towards. Let me drop that. Let me just drop this in. Let's use the top of this so we don't even get crazy. Let's use that 252, right? Instead of the 275, just for a moment. We're just going to use that opening price, and that's your breakdown bar. By the time I get up there and I get through this, these two could touch, right? But either way, these are your levels, and this is what I need to watch. And I would go out there and start looking at some of these upper levels, because they're definitely there. And let me just drop this one in so that you can see it right there. 1 second. Thought I had it there. There we go. Boop. So I would not be ruling that out. There's a lot of minutia at that 275, but these are levels you want to watch, and you want to watch how you're flipping on that RSI for sure. Now, I want to get into this. So just so we get this, this is non-farm payrolls, and I'm going to just point something glaring out. Okay. Has this mattered at all to anyone? I mean, look at that line. This is the line that we're watching like crazy, right? Every month we're watching it like crazy. 14 months, 13 of them have been higher. And this is the line that everybody's watching and they're all making their decisions on. It's a straight line, man. It's been a straight line since the pandemic. This is what everyone's focused on. It's a waste of time. This is the chart that keeps me up at night when I look at the financials and I see what's going on there. We came down here, we tried to crack that level, we were unable to. So I still have this huge bear pendant out there, and we're still below the 200. Maybe we're making progress because of Friday, maybe. But this is the one that I really need this above the 200, and I'll start feeling a little more confident. If you start looking at how people are pushing their money and where their money is going, XLY versus XLP is a great way to do that. And you can see very clearly what is happening here. People are buying their wants and not their needs. That means disposable income is probably higher than what people think it is right now, and so is personal savings. It's a much easier guide to look at than to look at some of the back testing econ data that comes out of the government. Now the fun stuff. So if we take a look at small spec index positions, we've been looking at this for a period of time, right? We've been looking at this probably for about the beginning of mid-April, we'll say. We started really focusing on this. So this is 10 years, 15 years, 20 years, all the years that they go back in data, and this goes back about 50 years, we're going to say, okay? And I just want to point out and be Captain Obvious, and we can all see this, and being this net short despite this little rally up here, okay? This is pessimism in green. That's pessimism in green. Okay, this is optimism in red. And you can see from 2000 to 2009 how you had optimism and flipped to pessimism. You have never been this short in the market in 50 years, and the market's going higher. How long do you think that these people are going to be able to stay that short? They're just not. It's not going to work that way. Eventually, they're going to have to make some kind of decision. And the decision they're going to make is that they're going to have to cover their short. And you can already start seeing it happen, right? The people that were short in September, all of a sudden they're not going as short as they were in March. They're not going as short as they were when? In May. So you're not hitting new net shorts, right? The net position's not short. They're starting to cover. Okay, this is significant. So when people are out there talking about this correction and nobody sees it, no, all the hedge funds are leaning that way. Small spec is hedge funds under about 20 billion. Now, one of the statements I made earlier was when you're looking at this data, it's important you understand what the data is. Now, if you've been watching this for a period of time, we do not call this smart money. We do not call this dumb money. We call this retail and we call this institutional. I noticed a pattern here that we're going to go over. I noticed that when we take out a lower low and then a high on retail in red, when we have these crosses, we tend to push higher. And let me show you what I mean by that. So you go here, and let's zoom out on this. Let's make this a year for a moment and get into this. So if we go out here and we look at this, and you go lower low, crosses, high, right? Lower low on retail, crosses, high. So when retail is crossing institutions are selling, retail is buying, okay? When that happens and the market has this lower low pattern, almost like a pendant, they have been the biggest moves that we've had, right? And this is actually what I do. I look for these kinds of anomalies. Like, now, why is that? I don't know. You know, I'm not sure yet. But as we're making lower lows, as pessimism is increasing on the retail side and institutions start getting more pessimistic, it looks like retail is candidly ahead of them. I think that's a really important distinction. You start looking at these over 3 years, 5 years, and you start seeing glaring signals. And we just got another one, maybe 526. We just got another one. And what these are doing is not only are they marking bottoms, but they're telling you that you're going higher. If you look at these levels that I'm talking about, every single one ended with a higher high. And I think that's a really important distinction, right? You're not going to see this often. It's not like it's going to happen all the time. But when it does happen, we should pay attention to it. That's it. Please comment on this video. Please share this video. It's showing me in the algorithm that people are sharing it. So I appreciate that. It's really important to me that this gets shared and that people understand what it takes to truly be successful at trading. Have a great day, everyone. Trade to win.